Hello, everybody. Ed Yardeni here. Well, it's spring, or it's almost, and it's been raining a lot here in New York. And as they say, April showers bring May flowers. And meanwhile, for those of you who don't want to go all the way down to Washington, D.C. or Tokyo to see the cherry blossoms, you can come to our backyard, and you can see we have some pretty nice cherry trees that are blossoming. The only problem with them is the rain brings down a lot of the flowers, so they don't last very long when it rains, and even when it doesn't rain, it's like a 2 week phenomenon. But it's pretty, and just wanted to share it with you all. Well, why don't we just keep it on just to stay in a happy mood here? I know that it's been hard to have a happy mood here over the past several days. I guess it really started before Liberation Day, before April 2nd. But before then, I think the market was down single digits. There were obviously some areas where the market was down more, but it was just a pullback really up until then. And then a lot of people thought that April 2nd might be Liberation Day in terms of, well, there's a lot of uncertainty that's been driving the market down. So on April 2nd, we'll get the details of what they're doing, and that could very well make a bottom. That was April 2nd. Well, we didn't make a bottom. We weren't convinced that that necessarily would be the bottom. Certainly, it wasn't the bottom, and there was plenty of uncertainty still left about what Liberation Day reciprocal tariffs were all about. There was a cockamamie formula that was used to calculate these tariff rates, which really made no sense whatsoever. They were way too high relative to what expectations were. And the president said that he was actually very generous because he took the formula and divided the results in half, and it still was mind-boggling tariffs. But we always have to think about the art of the deal, and Donald Trump is, at least in his background, as a New York State real estate developer and a New York City real estate developer. And I think it's important to remember that when Trump and other developers get into negotiations with their trade unions, with their contractors, with the government, with whoever, they typically do it behind closed doors, and they scream at each other, they bully each other, they threaten each other, and they each say, I got more cards than you've got, and I can last longer than you can. And then finally, they do work out a deal, and the doors open, the press is out there, and they shake hands and claim that everybody's happy, everybody got a good deal. Well, the problem we have now is Donald Trump is the president, and the same style he had in negotiating deals in New York seems to be still the style that he has now. And it's kind of disconcerting because it's all being done in public. It's not being done behind closed doors. It's all very, very much open to the public. And it's not a pretty thing to watch. I think there was an analogy of, you don't want to go to a sausage factory to see how they make sausages. You'd never eat the things. So again, it's not a pretty thing to see unfold. But in any event, that's what we're dealing with here. And I think what we learned last week is, at least on April 9th, is that President Trump doesn't want a depression. Maybe he's still willing to tolerate a recession, but I think he's got to recognize that if you tolerate a recession, you have the risk of it turning into a depression, especially when you're dealing with something as explosive as tariffs. Recently, been talking about Trump's tariff turmoil, and another version of that is Trump's nitro tariffs. He's kind of messing around with liquid nitro, and that can be rather dangerous. And I guess the bond markets kind of made him realize that's the case. So let's kind of go back again. So April 2nd was Liberation Day. The market took a big dive on the third and the fourth. On the fourth, Fed Chair Jerome Powell, remember him? Remember the Fed? Everybody's focusing on the White House, but on the 4th of April, Jerome Powell gave a speech and he basically said, "Whoa." He didn't say that, but he said, "Whoa, these tariffs are bigger than we expected. And as a result, the inflationary impact is likely to be higher, and the impact on the economy, the depressing impact on the economy, is likely to be greater." That's what he said. And so that kind of puts the Fed in a very awkward situation where they're expecting more inflation. And by the way, he said that previously he'd said, well, tariffs probably just have a transitory effect. I don't know why he wanted to use that word again. It didn't serve him very well back, I guess, what it was, 2021, 22, when he said inflation might be transitory. Well, it turned out to be not that pers persistent, but it wasn't all that transitory either, and it certainly gave the Fed quite a scare and forced them to tighten. Well, where are they now? Well, now they're thinking inflation is going to be higher than we thought because the tariffs are higher than we thought, and we still think they could be transitory, but then again, they could be persistent. He said that. And he also said, as I mentioned, that the impact of all these tariffs could be for weaker economic growth. So that's kind of a nightmare for the dual mandate, right? On the one hand, they have to worry that inflation is making a comeback here, and they don't know whether it's transitory or persistent. And they certainly don't want to make the argument that they're lowering interest rates because they think the inflation we're experiencing is transitory and it turns out to be persistent. They'll really lose all credibility. And at the same time, they're probably starting to think that, well, the unemployment rate could jump up to 4.5% here if these tariffs cause a recession. And, we're still at 45% subjective probability of a stagflation recession kind of environment. So we're not over the 50% mark, but others are. And Ray Dalio is talking about a depression. But others, I think Larry Fink is talking about us in a recession now. So there's a lot of talk about recessions. And so that's kind of a nightmare scenario for the Fed. And I think it puts them on hold. I mean, they've been on hold. When I was looking at it along with Eric back in late last year, we disagreed with the Fed's decision to lower interest rates by 100 basis points, and the bond market agreed with us because the bond yield rose rather significantly following the easing by the Fed. And then the Fed went into pause mode, and let me just hang this up. I don't know what's going on. Okay. Then the Fed went into pause mode, and what did they say? They said, we're in no hurry to ease. So we interpret that as the Fed being fundamentally dovish. They were talking about easing. They weren't thinking about raising rates. They weren't thinking about keeping rates flat. They were just saying we're no hurry no rush to ease. And I think given everything that's happened, that's still very much the case. So that was April 4th. Then we got into last week, and last week we continue to see downward pressure on the market, and we saw the market increase rather sharply on April 9th after Trump said, well, maybe we'll postpone the tariffs for 90 days, the reciprocal tariffs, except on China. China's tariffs are still 145%. So clearly ostracizing China relative to our tariff situation. And the claim is that lots of countries, forget the number, I think they were talking about, could it be 60, something like that, countries had called up the White House and said, let's talk. And so they're going to hold off on that. So I do think that April 8th might have made the bottom in this correction. I think it's still, arithmetically speaking, it doesn't feel like that, but it never feels like a correction. But when it's taken a dive, but it's, I think we just got into like, we didn't cross minus 20% on the S&P 500. So we did have a good rebound in the S&P 500. The Nasdaq did get into bear market territory for a few days, and now we're back in correction territory. I don't think we're going to get a V-shaped bottom in the market, though it certainly felt like that on April 9th, and maybe that's a surprise. But usually you get a V-shaped bottom when everybody's panicking, everybody's bearish. Well, check that. Everybody's still kind of in that mode. But the Fed also responds to all that by lowering interest rates, and you get the Fed put. Maybe the difference this time is that Trump basically created his own crisis with tariffs. This is a, a tariff crisis made by the president. The way he's orchestrated, the way that he's pursued it, has certainly created a lot of anxiety around the world. Stock markets are down. A lot of concerns that this is going to cause a global recession. But so Trump created his own crisis, and there for a while there, he was saying he doesn't care if the stock market goes down, and Besant was saying, it's just kind of normal. And Besant kept saying that the White House is trying to help Main Street. They don't care so much about Wall Street. And I kept saying, wait a second, Main Street, 60% of Americans own stock. Maybe, lower income, lower wealth people own stock, and it isn't that much, but to them, it's a hell of a lot, especially if they've been seeing it going up, up, and up. And for retirees, people my age, baby boomers are retiring. I got friends who are calling me up and say, Eds, what's going on here? And, they weren't doing that about 6 months ago. They didn't need my advice. They were just happy as could be. They were in the stock market. They'd go on their cruises, and on the cruise, they'd look on their smartphone and think what geniuses they were. They were able to retire, and lo and behold, their portfolios are going up. So they're spending money, and their net worth is going up. Now, all of a sudden, over the past several weeks, it's Ed, what's going on? Because and one of them was actually on a cruise, and they're looking at their smartphones, and now they got a negative wealth effect. I know, by the way, there's a lot of controversy about what consumers are going to do. I think there's still data suggesting that consumers are still spending. I don't want to be glib about it, but I've said for a long time that Americans are amazing. When we're happy, we shop, and when we're depressed, we shop some more, as long as we don't lose our jobs. And so far, initial unemployment claims suggest that the labor market is hanging in there remarkably well. I don't think companies are just kind of willy-nilly start to fire people because of tariff and uncertainty and not knowing where Trump's going to go next. Labor is still scarce, especially skilled labor. So I don't think that's going to happen. Maybe we're going to get a slower pace of hiring, and that could lead to a higher unemployment rate. But again, our view is that the economy is going to actually look pretty strong over the next few months. March, April, May. We had a really strong increase in auto sales during March, and I think some of that was weather. I know some of you are tired of my weather story, but January and February were bitterly cold, and maybe people went to buy cars in March, but clearly they also started to hear more about tariffs, and that would lead to higher prices. So there's a lot of scrambling going on to buy cars, and that probably continued big time in April and maybe May. And then the economy may very well be vulnerable to a recession. If so, we'd probably be in a no growth or a growth recession. The idea that the economy won't be growing and won't be growing much. But it could also obviously be worse than that if the consumers really retrench and capital spending really retrenches. But we're not there yet. We may be pulled in that direction, but we're thinking that the economy's resilience is going of the past 3 years is going to help out a lot in the current situation. And look, again, Trump has given us a crisis, and what Trump is also giving us is a whole bunch of almost daily Trump puts. Right? I mean, we're not going to get. I think the bond market started to realize that there's no Fed put, so what's the rush to buy bonds? And by the way, this freak out last week on the bond market, it's like, what's the excitement about? Okay, I know bond yields went up a lot, but where did they go to? The 10-year went to 4.5%. That just happens to be kind of where we think it should be. We've been arguing that the 10-year bond yield should be 4.5% plus minus 25 basis points. Okay, a week ago we flinched and we kind of lowered that by from to 375 to 425, but we're back at 4.5 plus minus 25 basis points. That's normal. That's kind of where we were before the great financial crisis. So we don't see that as a particularly big deal. All this talk about, the Treasury securities are no longer safe assets. The dollar is no longer a safe currency. I think that's kind of panic hysteria kind of talk. And the reality is that, again, the administration, this president, creates crises and then backs off and pivots almost daily now, providing puts and of course, lots of confusion along the way. So now I guess we have about 90 days to see what happens to reciprocal tariffs for all countries. We have a month or two to see what happens on semiconductors. But did you notice that NVIDIA is out today? I think it's just today, saying that they're going to spend like $500 billion on producing AI computers in Texas. Texas should build a wall around itself because everybody wants to build in Texas. And Texas is attracting a huge amount of capital into the state. Look, I mean, Trump's wheeler dealer approach, New York City developer approach, it's the bully boy, it's bluster, but it is having an impact. I mean, there is capital being at least pledged, committed. Feels like kind of like one of these charity events where people are sitting at the table and raising their hands for, how much are you going to contribute so that I don't hurt you. And again, a lot of us don't like that style, but it does seem to be working. So the world's not coming to an end, in my humble opinion. I was on CNBC this morning, and Becky was off, and Kelly was on, and she interviewed me, and she said that I have a calming influence. So I'll take that. I don't mind having a calming influence. But before that, about 15 minutes before that, she interviewed Janet Yellen, and very nicely, Kelly asked Janet Yellen and said, "Well, Yardeni's talking about what you did in November 1st of 2023 when you dealt with a bond." She didn't say bond vigilantes, as far as I can recall, but she said she recalled that in November 1st, 2023, Yellen basically told the bond vigilantes, "Well, if you don't like my notes and you don't like my bills, I'm just going to give you more T-bills." And we had a huge bond rally when the auctions, the note and bond auctions suddenly weren't going to be as awesome as people had feared. And Bessent criticized her for doing that. And as a matter of fact, the Treasury has a committee that guides it. I think it's a private sector committee that guides it about, how much you want to raise in different segments, maturity segments of the market. And Eric brought this to my attention. That's 20% is the max. And she took it up to 22%. And Bessent criticized her. And then he became Treasury Secretary and said, "Hey, this is not a bad idea," and just continued her policy. And then in the morning briefing today that I wrote mostly about bonds, I said, well, why not take it to let's just take it to its logical extreme. Why not just borrow everything in the T-bill market? Why not just tell the bond vigilantes, okay, you're out of business. We're not going to be issuing any more notes and bonds. Of course, there'll be, $37 trillion of debt out there, and a good part of it is still debt, and there's corporate debt and mortgage debt. So the bond vigilantes could still have a say in what happens in the bond market. But in terms of deficit financing, financing everything in the Treasury bill market would mean that the Fed would basically be monetizing all the debt. Now, in other words, the bond vigilantes really wouldn't have as much influence on inflation, and most of the heavy lifting would be up to the Fed in that kind of scenario. But it doesn't have to go to all T-bills. It could just be another announcement. I think the next announcement is April 30th. On April 30th, it can Besson could say, in light of uh, the Carfuffle, I think that's the way it's pronounced. That was how Jamie Dimon described it. He said there's more Carfuffle coming in. It's hard to pronounce. He said there's more of that coming in the bond market, and all Besson has to do, I think, is just say, okay, we're going to issue even more bills and reduce the issuance of bonds and notes, and I think that would calm the bond market down very well. So, I was asked this morning about the deficit and why I don't worry about it. And I've said and I've written, I've been doing this for 45 years. I don't have my bookcase in the background here, but my bookcase is right behind me. And in the upper shelf, I have about 15 books, mostly from the 1980s, but some more recent, about how the deficit's going to be the end of us and going to be a total calamity. And my conclusion is I'll worry about the bond market when I'll worry about the deficit when the bond market worries about it. And I kind of got a little concerned back in 2023 when we went from 4% in August to 5% in October, in just a very short period of time. And the auctions were kind of sloppy. They didn't go well. And that's when Janet Yellen on November 1st said, well, maybe we can get cleaner, better auctions if we do more of it in the bill market. So again, there are puts, if you will. We could have the yield curve control put from the Treasury, which means kind of changing the maturity structure of the debt to calm the bond market down. I'm sure we'll get lots more Trump puts. Yeah, he talks to everybody. He loves to talk to everybody. I listened to the recording of Bill Maher. Bill Maher was invited to visit. Kid Rock had arranged a meeting between Bill Maher and Donald Trump, and they don't like each other. Period. But they're both big enough to say, okay, we'll do it. And Bill Maher's take on the meeting was really quite interesting. There's a Donald Trump sitting around a dinner table at Mar-a-Lago, and then there's a Donald Trump that is the bully and the bluster and so on and so forth in public. And Bill Maher, he didn't change Bill Maher's overall opinion of Trump's policies. He agreed with some and disagreed with others. But he said, you could talk to him and you could actually criticize him, and he doesn't kind of go ballistic about it. So he talks to a lot of people. Apparently, he even asked Bill Maher what he thought about his policies. So he seems like he's constantly getting feedback. Obviously, it'd be much better if things were done in a less boisterous, less noisy way. But hey, look, it is what it is, and we have to incorporate it into the way we think about the markets. Again, this is not to say there aren't risks. This morning, I put out a quick takes on concerns about Taiwan. During the campaign, Donald Trump was asked by the Wall Street Journal, what are you going to do about Taiwan? Will you defend it militarily? He said, I don't have to do that. I got a great relationship with President Xi. He knows that I'm a crazy man. He didn't quite, he used a four-letter word to describe how crazy he is. But he also said, unfortunately, he said that, well, if push comes to shove, I'll just tax him. I'll just put a tariff of 150% to 200%. I mean, I'm sure the Chinese are kind of rereading that and saying, okay, so he's already played his card. Remember, this is the guy who says, I got more cards than you have. And he just kind of played the only card he had vis-a-vis Taiwan. And that raises the question, so why wouldn't the Chinese go forward with their blockade of Taiwan and invasion of Taiwan? So again, it's not as though there aren't things to worry about. I don't have a solution for that, but then again, I'll give you some opinions along the way, though I'm certainly no military or geopolitical expert. But that doesn't mean I can't have an opinion on these things. Well, we covered a lot of ground here, and let's go to the Q&A. Oh, you know what I forgot to do? I forgot to show you the charts. So if you'll bear with me, let's do that real quick. So everybody's worried about the government deficit. As you can see here, this is percent of the deficit as a percent of GDP. This is disconcerting. Usually deficits are at their occurred during and after and right after recessions. This time around, we have a deficit that's substantial when the economy has actually been doing pretty well. We've got outlays relative to GDP above their historical trend. We've got revenues kind of at their historical trend. So clearly the outlier here is outlays. This is the amount of debt, total debt, including internal debt that Social Security and other agencies have. So that's a big number, all-time record high. This is what it looks like relative to nominal GDP. And this is when these books were written, when the debt started rising faster than nominal GDP is when we first started to, and I started out my career in 1979, maybe 78. But anyways, it was almost instant that people started to worry about the deficit. And as you can see, the debt continued to increase relative to nominal GDP. So I'm not telling you I'm not worrying about it, but I at some point Ray Dalio may very well be right, and we may have a debt crisis where nobody wants to buy US Treasuries. But look at what Yellen did. Look at what Yellen did over here. The bond yield went up from 4% in August of 2023, got up to 5%. And then right around here on November 1st, Yellen issued more bills, and that helped to bring the bond yield down, as did lower than expected inflation. Then people started to realize the economy was doing well. There's still a lot of talk about a recession around here, and the bond yield went up. This is the next point. This is where the bond vigilantes came in. So I guess you could argue this was a bond vigilante experience here, where the bond market started to not do very well because the auctions weren't going very well. The next experience was right here, where Eric and I were saying the Fed shouldn't be cutting, and they didn't listen to us. So they just they did that. Now that Eric is going to the Council of Economic Advisors, he'll be down in Washington, and maybe he can talk to people. Just go into Powell's office and tell him what he thinks. But I hope I've had a lot of influence on him in the time he's been with me. But anyways, the Fed cut the Fed funds rate. They didn't listen to us, and everybody was surprised that the bond yield went up. We weren't. And then here's Liberation Day, and everybody was freaked out that at first Liberation Day was viewed as recessionary, and then people said, well, maybe it's actually inflationary more than it is recessionary, and the bond yield shot up here. But that's kind of where the bond yield should be, in my opinion. This is the chart that Eric introduced me to. This is the U.S. Treasury bills as a percent of U.S. Treasury market debt. This is where they're supposed to have it, around 20%, and Yellen took it to 22%. Again, not exactly the end of the world, and it helped. It worked. One has to be pragmatic when one makes policies, or when one invests and tries to decide what to do next. Can't let your theoretical and philosophical and religious biases influence your investment thinking. But here's that 10-year bond yield. Still looks like it's kind of consolidating at where it was before the great financial crisis. I don't really have a problem with that. This is the deficit. I got a problem with that, as we all do, to see this deficit going up. Um, this is expected inflation. I didn't see today's expected inflation data from the Federal Reserve Bank of New York. So if somebody wants to put that the Q&A, please do. But this just looks a little crazy. Usually this thing correlates real well. Expected inflation correlates with gasoline prices, and gasoline prices have gone down, not up. So I guess that Trump is just driving everybody mashiggy, as we say here in New York, with his tariffs and how inflationary it might be. And that can have consequences, obviously. I hope Besant points out to Trump that while we're running this large balance of payment deficits on a current account, which is basically the trade deficit, that's been offset, as balance of payments always balances, and that's been offset by record net capital inflows to offset that. And, creating a lot of disorder here in a system that is fairly well balanced can create disturbances like the one we saw last week, maybe in the bond market. That's it. Let's go down here to the Q&A, and I can take a few of them. Let me go to the end here, see if anybody threw in a. No, I guess nobody looked at the FRB New York expected inflation, but you can expect we'll write about it. So, Ian, your take on what if scenario if the deficit continues to hike up and impact with bond vigilantes, U.S. deficit versus trade deficit importance? Yeah, these things are all interconnected, and as the current account deficit has gotten larger, it has to be balanced off one way or the other by capital inflows. Of course, another adjustment mechanism is the currency, and the currency could go down, the dollar could go down and attract more imports and attract more exports, stimulate more exports from the U.S. and dampen imports, and that's another way to deal with it. I'm not in the dollars in a calamitous decline camp here. It's been moving kind of in a range. It's kind of the bottom of the range, so maybe something to worry about. But I don't expect a calamity here. Let's see. I think that's Brian. Yeah. Hi, Ed. Given the now tricky dual mandate situation, do you think the Fed will use an unemployment level to lower rates? If so, what level? Yeah, I think 4.5, as you said, 4.5 to 5%. You had that in your queue. My A is 4.5 to 5%. They'd probably give unemployment more weight. But tell me what inflation is doing. I mean, if they got, we're still thinking inflation is going to pop up to 3 to 4% on a year-over-year basis. We're doing some work on maybe that's too aggressive. I mean, oil prices are down, fuel prices are down, airline fares are down. It's kind of interesting to see that airline stocks aren't doing well when the price of jet fuel is going down. So there's anecdotal evidence that people are traveling less, maybe doing fewer cruises and things like that because of all the uncertainty. So that could be some weakness in areas of the economy where inflation comes down. The problem is, I wish Trump would give us a postponement on the 25% tariffs on cars. That's going to be a bad news in increasing prices by 5,000 to 10,000, and then that'll immediately feed into auto insurance. So right now we're still using 3 to 4% through the end of the year, and then back down to 2 to 3% for inflation next year. Who does Trump listen to on economic matters? Well, he was listening to that amazing, smart, widely respected economist, Ron Vera. Ron Vera was an invented economist. Ron Navarro invented him in his book and kept referring to the brilliant Ron Navarro. I forgot Ron anyways, it was a play on his name, and I got a Biden moment on that one, but it was a play on his name, and I think he's less. I hope he's listening less to Navarro. I wish he'd get rid of Navarro, and I guess he's listening more to Besant. I think Howard Lutnick is also a little bit uh, off key, so I hope he's not listening to him either. But let's see, we got John. Hypothetically, if it turns out Trump stays throughout his term a mercantilist and impulsively unpredictable with low growth and 3% inflation ensuing, where might it take out current PE of 21 and 10-year bond of 4.4? Yeah, I mean, I don't know where you got the current PE of 21. The forward PE is, I think, down to 17, 18. So we're well below the 21, 22 range. So the market has re-rated here on all this uncertainty. Look, if we don't have a recession, I think uh, we could retest maybe 15, 16 as a forward PE and then kind of bounce off of that. It's conceivable that we got to about 17 on April 8th, and that might be it in a no recession environment. And keep in mind, I think some of the economic data is actually going to be surprisingly strong in the next few months. And if at the same time Trump continues to pivot or actually make some real progress on negotiating deals, or at least claims victory that he's made progress, that's all we really need to get the stock market to do better. We could have a weaker economy in the second half of the year, but the stock market will look past that and look at 2026 and maybe give some credibility to my roaring 2020 scenario. I haven't given up on that one yet. Let's take a couple more. Yeah. Hi, Ed. Can we talk about the dollar drop and revisit your international equity allocation opinion going forward? Yeah, I did a chart on that in the quick takes that I sent out last night. And if you look at the US MSCI divided by the all country world ex-US MSCI, both in local currencies and in dollars, both those bounced off their long-term uptrend lines. And I kind of said I thought it might do that. I'm not that convinced that the rest of the world is all that attractive relative to the United States. Certainly on a valuation basis, it looks more attractive, but sometimes valuation metrics do give you an insight into the prospects of various economies. Yeah, I'm not particularly concerned about that dollar drop. Ask me again if it keeps dropping, but I'll write about it, obviously. By the way, a lower dollar is good for stimulating our exports, and it should depress our imports. The problem is it'll also be inflationary because so tariffs go up, and what you need to offset tariffs is a stronger dollar, not a weaker dollar. A weaker dollar would actually exacerbate the situation, but it would be great for earnings. So not necessarily offsetting all the negatives, but it would be a positive for earnings. Take one more, and then I've overstayed my welcome. Michael, can you talk briefly about who exactly the bond vigilantes are and what they do to influence fiscal policy with the bond market? You got an hour or two on the website. You know what? I'm putting together a primer on the bond vigilantes. I had one. I want to update it. But basically, anybody who owns a bond or conceivably might be a bond buyer, any of us are bond vigilantes. If we don't think that the Fed and the Treasury are going to keep law and order in the financial markets and in the economy, keep inflation down, and if they don't do that, then we are not going to buy bonds or we're going to sell bonds. And we saw that an example of that, as I said, in 2023 when we went from 4 to 6%, 4 to 5%. But what we also saw is that in a free market, there's always going to be some price, some yield at which buyers are saying, you know what, this is good enough for me. And it was 5%. Then I think we got to like 4 3/4%. Was it earlier this year or late last year, and that was good enough for people. So I still think 4.5% plus minus 25 is kind of the right range. And a lot of people talking about, oh, we're going to go to 0.5 and going to go check out, we're going to go to 5%. We're going to go to 6%. Well, look, I could be wrong, but I promise you that I won't change my mind more often than the president. On that note, happy spring, happy Passover, happy Easter, and keep smiling. Thank you.